In this week's update, valuation reset is done. Now for the next phase. Liberation Day. Trump liberates investors from their capital. Keep your head, you'll be fine. And gold caught up in the unwind. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information presented here is general information only. All right, this is going to be a longer video than most. I would really encourage everyone to watch it fully because I honestly think it's going to change your investing life. We're at a critical point in the market, which is just screaming opportunity, but most people won't get it because they're being guided by their normal emotions, and we are not wired to take advantage of this. But if you watch this and embrace the concepts that I talk about in this video, I promise you it'll change your investing life. All right, let's get into it. The normal playbook is occurring. It occurs every time, whether you go back to 1987 or the GFC or COVID, whatever it is, the normal playbook in broad terms is playing out. And it's really what I've been saying over the last few months. And I've been saying that because all I'm doing is something very simple. There's no magic. I'm just reading the chart patterns, and I've been doing it for a couple of decades, and I'm pretty efficient at it. And that's it. It's no more complicated than that. Towards the end of 2024, I said the US market was overvalued. It just needed a trigger, and Trump's tariffs have certainly provided that trigger. But if it hadn't been that, it would have been something else eventually. And then once you've got the trigger, then people start to sell, the market dynamics kick in, so normal psychology kicks in, and down the market goes. And it's a matter of reading the market on the way down. The character of the bounce tells us a lot about the next phase. Is it going to be a shallow, brief correction, or is it going to be something more significant? And I think it's pretty obvious now that we've got something more significant on our hands. Where's the bottom? I really don't know. In fact, I purposely do not think about it, because all that can do is colour your thinking, and that puts a subconscious bias in your head, and you definitely don't want that. So I'm not even thinking about where the bottom is. And I don't need to, because I clearly know what the bottom looks like and what the reversals look like in individual stocks. So let's jump in and look at some charts. And perspective is just absolutely critical at the moment. And the first thing I'll do, I'll just show, this is a chart, a long-term chart of the VIX going back before the GFC. And the spikes that I want you to pay attention to are the ones above 40, so here. So this was obviously the GFC, 2008. We spiked above 40. We had another little spike in 2010. Again, and a spike to 40 is a very, very significant event. I shouldn't understate it, because a VIX of 28, so the VIX normally sits around 20. A VIX of 28 is one standard deviation. A VIX of 40 is more than two standard deviations away from the mean, and those things don't last for very long, as you can see. So 2008, 2010, 2011, 2020, and we got not too far away in 2018 with the last trade war, last tariff war, 2020, and now this one, and we've spiked up to 45, basically on Thursday and Friday. So that is the backdrop. So if we look at, and what I'm wanting to associate here is, because spikes above 40 on the VIX are so rare and so brief, do they mark something near the bottom? And the answer is yes, they do, but that can be a period of up to 3 or 4 months. So on the 24th of the 10th, 08, when things got to an extreme, which was just in there, the market had gone down quite a long way, but it continued to go down after that and actually hit a peak or a low point on the 6th of March. So it was actually about 4 months before the index started turning up. Now, I can tell you that a lot of stocks started turning up before that, well before that, in fact, before the end of 2008. But considering what the GFC was about, it wasn't that far away. The next one was May of 2010, which was the flash crash. Now, the VIX a lot of the time the market is hedged for risk. And so you don't tend to get these extreme VIX readings because the market is expecting what is coming. And so it's hedged. But the flash crash in 2010 came out of the blue. And then again, and you can see there that we were pretty close. That peak in the VIX was pretty close to the ultimate bottom, and then the index started moving higher. And then it happened again in 2011 in September, which was associated when the US credit rating was downgraded. And again, it was within a few weeks of the lows of the market. One forward to 2020, that was obviously an unexpected, totally unexpected event. So it hadn't been hedged. And you can see the VIX spiked and the market went down very quickly. Now, this decline at the end of 2022 was when the tech stocks unwound for fully 12 months. But the VIX didn't spike then. And the reason being was that it had been hedged. A lot of the bigger players had acknowledged the overvaluation in the market, knew that it was coming. And so they'd taken a hedge position. And so that was why the VIX didn't ever spike as much as it did, because it was already done. The work had already been done. It had been hedged. But this one, I don't think anyone saw. I'm sure there would have been hedges in place for Trump's tariffs because we've known about those for 12 months that he was going to impose tariffs. But I think it was the severity and the broadness of the tariffs that hadn't been hedged in and caught the market off guard on Thursday and Friday. And you can see, particularly Friday night was just an absolute bloodbath on Friday night when the S&P goes down 6%. That's a pretty rare event. So when the VIX spikes above 40, which is where we are now, they're extreme, they're rare events, they're unsustainable. They don't last more than a few days or a few weeks. Now, this is really interesting, and I've got a number of absolutely vital messages, but this is probably the most important one and the one that I want to roll out first. This is from JP Morgan Wealth Management. The best trading days in history occur right after the worst trading days. Now, we sort of know that intuitively because the market ends in some sort of capitulation and then rebounds. But I wonder whether people who are selling out of the market at the moment actually understand that. The best trading days occur right after the worst trading days. And to quantify that, 7 of the best 10 days in the last 20 years, so 10 days in 20 years, 7 of those occurred within 15 days of the worst occurring. So if you sell out anywhere around the worst days and fail to immediately get back in, which is almost what everyone is going to do, then you are making a massive impact on your long-term wealth. If you missed 10 of the best days in the last 20 years, it cuts your long-term return from 10.5% per annum on the S&P to 6.2. Now those 4 percentage points is a life-changing difference over 20 years. And again, to quantify that, and these are all numbers according to JP Morgan, a $100,000 portfolio at the start of the 20-year period would rise to $809,000 over 20 years if you left it fully invested. But if you miss the best 10 days in that 20-year period, your portfolio would only rise to $344,000. And if you miss the best 20 days, then the long-term return drops to 3.6% per annum or 205. So you miss the best 20 days, which would be extremely easy to do, and you've cut your long-term return from 800,000 to 200,000. So when you try to get out of the way, just understand what it is that you're doing. You are shooting yourself in the foot with a cannon. So the question I would pose to everyone watching this video is, do you back yourself to be able to get out early so that you don't incur the losses, and then get back in again and not miss the best 10 or 20 days over a period of 20 years? Are you that good? I know I'm not even close. And so these sort of numbers just remind me of some of the key principles of smart investing. Now, it's not as straightforward as those numbers. You just set up a portfolio and then you don't touch it for 20 years. You can't do that either because it has to be actively managed. There's a lot of stocks that were great 20 years ago that are terrible now or that even got out of business. So you can't just buy and hold for 20 years. But the answer is you hold high quality stocks. And I'm going to keep talking about that. In fact, I talk about it every week, but I'm going to keep talking about this all the way through this video. Hold only high quality stocks for the long term. But recognize that those high quality stocks periodically change because things happen in the economy, things happen in sectors, and things happen to individual stocks. So they have to be actively managed. But if you're still holding high quality stocks and the outlook is still good, then hold those. Don't sell them into corrections. And it's pointless staying invested in lower quality stocks because that's going to give you a pretty bad return as well. If you're just going to do that, then you might as well try your luck. Try getting out and getting back in again. But if you can just embrace the concept of holding high quality stocks for the long term, unless something changes for them, and then swap them out for some other high quality stock, then you are so far in front. It's just amazing. So if you embrace that concept that I've just talked about in the last few minutes, I promise you it will change your investing life. But it's not easy because that's not how we're wired. So heading back to the presentation, the current decline, and I'll go back to the chart in a minute, but doesn't this look a lot like COVID when I go back to the chart? We've had a massive hit from left field. What Trump is doing, the dimension of what Trump is doing with tariffs was not expected. This has caught the market by surprise. And so, therefore, it's left an enormous amount of uncertainty. And that's what financial markets hate the most. It's not that they know that it's going to be a big hit event because that very quickly gets priced in. It's the uncertainty of what comes next that's really doing the damage at the moment. And so markets are scrambling to reprice risk. And in an environment where assumptions are almost useless, they really are, because how do we know what Trump is going to do in the next 60 minutes or next week or next month? It's impossible to know that. Is so unpredictable. So markets are trying to reprice risk at a time when there's just so many unknowns. The whole point of this video today is to keep your heads. If you kept your head during COVID and the impact on the market only lasted, it was severe, index was down 50%, but it only lasted a month. And then the market started going up again and went up spectacularly. So those that kept their heads during COVID did really, really well, made the adjustments quickly, created some cash, and then started buying at the bottom. They did just fine. And the same thing is going to apply this time. History shows that quality stocks sharply outperform after downturns. There's no question about that. Study after study shows that. And quality stocks only form a small part of the market, and they're not perceived blue chips. That's not a quality stock. That's just a cop-out. Because it's big and it's a household name, it must be safe and mustn't be very volatile. That's a cop-out. Quality stocks are something completely different. And frankly, I find most of them outside the top 100, not within the top 100. It's so very hard to sell and then rebuy at a lower price. It's incredibly difficult to do it with any level of success, and certainly with any level of consistent success. So I've got to ask the question, why would you do it? Particularly when you look at the numbers that I showed before that JP Morgan ferreted out. when you look at those numbers and you look at how difficult it is to sell, and I'm not saying that you don't cut your exposure, because in the Insiders Club, we've cut our exposure progressively over the last 6 weeks, and members are cashed up and ready to buy the opportunities. So I'm not saying that you can't sell, but I'm talking about selling out completely of high quality, good value positions. It's just so difficult to get back in again. So it just begs the question, why would you do it? History is so much on our side that quality assets will go on to set new highs. And you only have to look at the S&P to understand that. Let's go back to the charts. You look at the S&P and understand that after a correction, the market goes on and sets significantly new highs. It did after the GFC, which is almost hardly discernible here when you look back over history. And all the other events just goes on, and the high is much higher. It's not a little bit higher, it's much higher. And it generally happens pretty promptly. I just want to show a couple of other charts that are important. I think now I'm comfortable that we've had the valuation reset by and large across most stocks. And I've been calling for that valuation reset for 4 weeks or so now. And I think we've now moved into the next phase, and that's we're into overshoot. And overshoot happens because of human nature, and it also occurs because of leverage. A lot of players in the market were heavily leveraged to the long side. Otherwise, what else explains this move in Microsoft? A real capitulation on Friday night. Long range candle, closed right on its lows, very elevated volumes the last 2 sessions, after it's already been sold off significantly. The only thing that explains that, to my eye, is we're unwinding leverage. And when you look at gold, that sort of supports that as well. So we're unwinding leverage, but we've also got this phenomenon of ETFs. ETFs go on a spiral to the upside, which becomes self-fulfilling while sentiment is bullish. But when sentiment turns, then that spiral goes into reverse. People start selling ETFs. And so the ETF manager has to sell shares to create the capital to make the process work. And that will continue until we reach a new level. But that almost begs going to an overshoot position. But the good news is that all that generally plays out in the relatively short term. I'm talking a few months. And we've already been tracking down in Microsoft since December. So we've already been tracking down now for more than 3 months. MasterCard, this was one heck of a capitulation on Friday night. Is this the capitulation that follows a valuation reset? Maybe, maybe not. I don't know. I'm certainly not. I couldn't call the bottom on that. It needs confirmation. Let's look at Google. I've previously shown Google and what happened in the decline during 2022. So I thought it would be interesting to look at the fundamentals as well, because we got a 42% decline in one of the world's biggest and best stocks. So in December of 2021, the earnings were $5.69 a share, and the stock was trading on a PE of 26 times at that time. By the time we got to the bottom in December 2022, the earnings had dropped. So there was a rationale, there was a fundamental reason for the decline, and it had gone down by $1.10. But because the price had gone down more than that, the PE had dropped from 26 down to 19. So that was the 2022 experience for Google. Now let's look now. In December of 2024, the earnings had gone from $8.13. So in 2 years, we'd gone from $4.59 to $8.13. And the PE had gone back up to 24, partly because the earnings had grown, but the share price had gone up faster. Now, just in that brief period this year, we're now looking at the FY25 forecast is $8.96. So at the moment, and that may come down, but at the moment, the consensus forecast is for $8.96, and that puts Google on a PE of 17. Now, This is either extremely good value territory and it's in the process of overshooting, or the earnings per share is going to slide as it did in 2022. And this $8.96 number is going to come down. And that is what's currently being priced in. That's what the market is trying to price in. But is the market correct? Will the earnings fall from $8.96 to something lower that warrants this sharp sell-off? Because a PE of 17 is pretty attractive value. The thing we don't know is what will the earnings be by the time we get to the end of 25? That's the unknown. But given the laws of overshoot, if I can use that term, because it happens nearly all the time, this is going to set up a fabulous long-term buying opportunity. And I don't know where it is or when it is. We're going to let the market show us. But at the end of 2022, the base took 4 months. So across here was a 4-month period. But then the price doubled. And in the last 3 months, to give us a little bit of insight into what this $8.96 number is going to do by the end of the year, in the last 3 months, there's been 25 upward revisions by analysts and 28 downward revisions. Now, for a stock like Google, that is a lot. That is a huge shift, because normally you would see something more like at least 80% of the revisions would be upwards. So some repricing has already occurred, and that would be reflected in that $8.96. So coming back to my point, Google, for one, will present a fabulous long-term investment opportunity at some point in the not too distant future. So if Google is an asset that you want to own for the next 5 or 10 years, then I can tell you that a fabulous opportunity, which is being born out of the characteristic of the market's overshooting, is going to happen. Okay. Let's move on to the NASDAQ. Over the last couple of Sundays, I've said that I strongly doubted that this was the index low. So going back 2 weeks, which is back to there, said I doubt this is the index low, even though there was certainly some calls for it being the index low. What we got out of that was a dead cat bounce for a couple of days, and then the market just rolled over and went back down again. So the dead cat bounce was the first part of this week here. It went up. Then the market got clobbered and finished on its lows, and then ditto and more than ditto for the week that we've just had. So there's been absolutely ample warning to adjust your positions. And if I can just recap on things that I've said in the Sunday videos. January 19, which was this week here, I said you should only be owning high quality stocks. Get out of your rubbish. Get out of your lesser quality stocks and just go to quality. And secondly, know what your exit looks like. So that was said up here. If you've been caught with your pants down, then you just haven't been listening and responding. On February 9, I said the market character is changing. That was that week there. And 2 weeks later, up here on February 23, I said, we're well and truly into a valuation reset and you need to move up the quality scale. And that was up here. So there is absolutely no excuse for not having responded, other than you're just not in an environment where you're getting a clear perspective on what you should be doing. And that applies to many, many people. Let's move on and look at some of these other key ratio charts. This is the S&P versus gold, and we had a little blip for a week or two, and it just continues to plummet. So what this chart is telling you is that the S&P is dramatically underperforming gold. Gold doing far, far better. This is consumer discretionary versus consumer staples. Again, we got a healthy bounce, but only back to this little pause point here, which was a point of balance between those two markets. And then we've gone down again very, very sharply. Okay, so I've talked about missing the best 20 days in the last 20 years. It's something that is going to hurt you financially and hurt you a lot, hurt you a great deal. A far easier and far more profitable approach is this. And this is what I've been talking about to members and also in the Sunday videos for anyone that wanted to listen. Adjust early, modifying that adjustment as events unfold. And me personally, and also in the Insiders Club, we adjusted on a couple of occasions. We adjusted somewhat early on, and then as things deteriorated, we adjusted some more as events warranted. So do that early, create some cash. And you can do that by eliminating lower quality stocks. And if you don't know the difference between lower quality and higher quality, then you really do need some assistance and support, because you can't possibly function in the market without it. We also then started, as this correction unfolded, we then also reduced some of the ultra-high PE stocks. And everybody knows pretty much what they are. They're stocks like PME and REA Group and all those sort of stocks. The ultra-high PE stocks that have reached those PEs during a real bullish sentiment market. Now, they didn't start to fall over early on. That thematic started picking up steam a few weeks ago. And so that was an opportunity to reduce some exposure, to remove some of the downside pain, but also, and most importantly, to create cash so that we can grab these bargains. Use a hedge if appropriate for you. Some people are comfortable using a hedge because generally what happens with a hedge is you lose money on it. And so some people don't feel comfortable using hedges because they've done it before and they've lost money on it, and so they don't like to do it. But if it's appropriate for you, use a hedge, because then that can partially protect some of the stocks that you've got. And then the most important step is use that cash to add to your well-researched target list, which has been prepared in advance. And if you don't have a well-researched target list, then again, you've just got to put yourself in an environment where you can get one. If you don't have the skills or the time or the interest to have a well-researched target list, then it's like anything else in life. Get an expert to help you with that. We do it all the time. Well, why not in the market? It leaves me absolutely speechless, the people that don't want to invest in their financial future. So make life easier for yourself. And there's a couple of things that you can do during periods like we're in at the moment. Don't look at your portfolio bottom line. Sure, look at the stock prices, look at the charts. Nearly every online broking platform provides charts. So look at the charts and just track those chart patterns, but don't look at the bottom line. Oh, I'm down so many % today. Shock horror. Because that could do absolutely nothing good. All it can do is plant anxiety and indecision in your mind. It cannot do anything positive, knowing what your portfolio bottom line is. And then you add to target stocks as the charts indicate. Indicate that the buy and the sell balance is shifting from a market controlled by the sellers to a market that's starting to be controlled by the buyers. And this just gets back to chart reading. And chart reading is something, it's a skill that you develop over not a short period of time, because you've got to go through the various market cycles a couple of times until you really get it. Now, the valuation reset, I believe, is done. Now we're going to get the overshoot. I talked about the fact that the ETF dynamics works in both directions, but the good news being it doesn't last very long. And I've been saying this for the last few weeks. Some stocks will turn early and turn very sharply. And the bottom after the GFC, to pick the biggest event of, I guess, most of our experiences, although I was involved in the 1987 crash, but for most people, the GFC was the worst event that they've been in. And the index hit the bottom in March of 2009. But some stocks, particularly gold stocks, started going up in November of 2008, a full 4 months before. So some stocks will turn early and turn sharply. So you don't want to be working off the index here. You'll be far too late. And working off gut feel doesn't remotely cut it either. If you're planning on just waiting until someone like me tells you that the market bottom is in, then it's way too late. You're weeks, if not months too late. So you need to prepare in detail. You need to prepare early. And with the right information and support, this can all be done in a few days. If you're someone who doesn't really have a plan, doesn't have a target list, doesn't know what a good entry looks like, doesn't know what a high quality stock is, you can fix all that inside a week. This is not 12 months worth of education here. You can change this just almost overnight. The US economy, let's look at the market status. US economy at the moment, yes, inflation is set to rise. I think that's a really, really high probability. And that handcuffs the Fed. So that's difficult. The Fed is going to find it very difficult to cut rates. And yet they may want to cut rates if the economy falls in a hole. So the US economy could be heading for a stagflation position. Lousy growth, which requires stimulation, but the central bank can't stimulate because inflation is a problem. And then they're between a rock and a hard place. Having said that, though, the numbers on Friday night, the US labour market is still surprisingly resilient, considering all the federal layoffs that have already happened and all the uncertainty around tariffs. It's quite amazing that the labour market figures came through as they did. So that's the economy. Let's look at the market. There are some outstanding earnings results, and I spoke about one of them last week, a stock that went up 20% on one of the really bad down days because they announced earnings. And earnings were double what the market expected. So some of those are still coming through. Not many, mind you, because we're not quite in the mainstream earnings season, but they're still coming through. So that tells you there's still parts of the economy that are doing really well. And there's certainly evidence when you look at some of the valuations and the EPS growth rates that a huge valuation reset is now done. Markets don't need to fall any further based on valuations, but it's highly likely, given the signals, that they will, because we're getting into overshoot now. The market is not going to be priced fairly because we're unwinding leverage. We're unwinding the ETF cycle. And we've just got retail consumer panic. Let's go to the outlook. The US market, it's probably, and again, I only deal in probabilities. So when I make a statement about the future, I'm just making a statement about what is probable. I don't assign a lot of hope to it because that puts the wrong signal in my mind. But it makes sense to me, given where we're at right now and the emphatic nature of the selling, is that the US indices are weeks or months before completing a low. But quality stocks will rebound early, and they'll rebound hard as the smart money starts buying during what is getting a very, very gloomy period. Unfortunately, retail investors will wait until it's far too late to buy. They'll wait for some positive signal, and that'll be far too late. So what to look for? Look, I can't know when and where the lows are going to be, as I said earlier. You just need to be able to read chart patterns, and that's not something that you can pick up overnight either. But in very broad terms, the big turnarounds are very similar each time. It's the same sort of characteristics of candles, combination of candles and volume. Whether it's the GFC, 2018, 2020, 2022, this time it's similar. And it's similar because it's just human nature playing out as it always does. It's predictable. It just looks a bit different each time. Let me just, before I go on to this next slide, just let me go back to the charts. I just want to go back to the S&P. So just a reminder that after every big event, how quickly the market sets a new high. These were massive events. The GFC, and I think I've just excluded that slightly. Here we go. So these were massive, massive events at the time. We're talking about declines of up to 50% in the index. And yet look at it 20 years on. You can barely even see them on the chart. So again, unless you need the money in your investment account in the next couple of years, then why would you run the risk of selling out or trying to sell out and get back in again when you know how difficult that is to pull off? And when you look at a chart like this, that just keeps going up and up and up. After COVID, for instance, which people thought was the end of the world, and the bottom in COVID was 2,300 points on the S&P. Just recently, we were trading at over 6,000 points, more than 2.5 times the level, and that's just the index. What about some of the best individual stocks? So hopefully this message is getting through loud and clear. So to capitalise, you must have a plan. You must have well-researched, high-probability targets. You need expertise from others. Nearly everybody does, who've got the skills and the time that you don't possess. So don't shortchange yourself by trying to do it on the cheap or trying to do it by searching the internet. The answers are not there. The answers are in another place, let me just put it that way. So we're making a short-term offer to help people, investors, capitalise on what is building as an amazing opportunity. So normally the Insiders Club is at $249 a month. It's being reduced for the first month only to $149 as a trial discount to give new members an opportunity to see if they like what I do and if what I do produces results. You will also get direct communication with me to help with the plan, with questions about the market, with perspective, whatever it is that you require. You also get the targets as part of the normal process, the specific entries. So this stock, this day, this price, very specific. And most importantly, how we go about managing risk in the Insiders Club. So there really is very little excuse not to handle this opportunity coming up. And it's really, really important because I think, as probably many people are discovering in the last few months, it's actually far easier, particularly if you're new, it's far easier to lose money in the market than to make it. You've got to be organised. You've got to be very focused, very targeted. But the results that you can produce can be well above average. Let's look at American stocks now. The S&P fell 9% for the week. The NASDAQ, that's not correct. I'm sorry. I think that's something like 10%. Forget that. It's not right. I think I calculated the number and then forgot to put it on the slide. IWM was down 9.6 and the equal weight S&P was down 8.5%. So a real washout. Yeah, that's as bad as we've seen since COVID. The US dollar was very volatile, hugely volatile. It went down from 104 to 103, but it was down, I think, pretty close to 100 at one stage. So massive volatility in the currency. So that is why the fact when you see the currencies moving as they are, when you see the VIX doing what it's doing, when you see the 10-year yield in the bond market falling as it is, you know that this event was not foreseen. It wasn't hedged. And that's why the VIX has spiked to 43. I think I've looked at pretty much all the American charts that I needed to look at. I will look at the currencies though in a minute. The Australian dollar smashed support and was trading under 60 cents, down at 59.8. And 20-year lows, 20-year plus lows, because my charting package only goes back a bit over 20 years, and those lows are now in play, which would be a pretty disastrous event for the Australian economy and for anyone who intends to travel overseas. The ASX 200 index was down 4% for the week, but you can be assured that it's going to get smashed from a great height on Monday morning. We were 11% off the peak, so we're now into official correction territory, if you want to put a label on it. but we'll be down a lot more than that on Monday. IT and energy were the worst. The so-called defensives were the best. But, I got a totally different view about what constitutes a defensive, lower risk stock. And I get the best of both worlds because I get lower overall risk, but high growth. Now, that growth can move around a little bit when we've got the possibility of global recessions. But nevertheless, there are stocks out there that are high growth stocks and will continue to be high growth stocks with a high degree of probability. And that, over time, by definition, gives you lower risk. Now, it doesn't stop them being volatile. It doesn't stop the price going down 30% before it bounces 60%. But the absolute risk is much lower than many of the perceived. Would I rather own these sort of higher growth stocks than a Coles or a Woolworths or a Wesfarmers? You bet I would. And they're hiding in plain sight. Most people don't look for them. And 13 of the 21 core holdings in the Insiders Club in Australia are founder-led businesses. And that is one of the best places to go and find high growth, lower risk stocks. All right, let's go quick look at the Australian market, and then we'll look at the currencies first. So there's the US dollar on a weekly chart, but when you put it on a daily, so you can see we've broken through a key support level there. When you put it on a daily, you can see just the immense volatility that we saw on Thursday and Friday. That's quite extraordinary, hitting a low of 101. Now, if we look at the Australian dollar, we broke through this key support. This is a big long-term picture. So the next obvious support level is now very much in play, and that's 57.68. But if we tighten in on that, this support level here, which is what we've been looking at pretty much all year, we found support, we've rallied, but now we've absolutely obliterated it in just a couple of days. So that's not great for the Australian economy. If we look at the ASX 200, this is on a weekly chart, so you can see not a massive down week last week, but it will start badly. It will gap down below this key support level. Now, if we look at the likely contributors to this, I think materials are going to get hit. Information technology has already come off a fair way. It's going to get hit. Not sure about healthcare. Don't know how the market's going to treat healthcare. Finance, almost certainly going to get hit because the finance sector in America did. And energy got massively smashed at the end of last week with Woodside and Santos down around 9-10%. That's going to get extended further in the early part of next week. All right, while I'm here, let's look at the precious metals. Silver had another heavy sell-off. Now, part of the sell-off in silver and gold is related to the fact that we're getting an unwind. Big players in the equities market who have got leverage are being forced to sell other things that they don't necessarily want to sell, like gold, because it's liquid. Now, the good news about this is that any sort of forced selling rarely lasts very long because it has to get done pretty quickly. If you get a margin call, you got to get out. You got to do something about it pretty fast. So they don't tend to last too long. So that was silver, quite a hiding on Thursday and Friday. Sorry, that's a daily chart. So that's only 2 days. So marked down quite heavily. This is gold on a weekly chart. So you can see we hit a high of 31.67. Everything was looking absolutely fantastic. And then we got an abrupt turnaround on Thursday and Friday. And I would bet a great deal of money that a good component of this is forced selling. Now, on Thursday, the fact that the US dollar fell heavily and yet gold still went down, and then the US dollar reversed back up again quite sharply on Friday, but still gold went down. Now, that's just come out of the blue. So that's why I say that this is almost certainly forced selling and therefore will not be terribly long-lived. This is the Australian dollar gold price. It actually, on a daily chart, it actually spiked as high as 52.38 on Friday night, ended up closing 5028. And just while I'm here, this is Bitcoin. Bitcoin was surprisingly resilient on Friday night. That was a real surprise. So precious metals, gold net down 45, peaked at 3168 and 5054 in Australian dollars. I think those numbers might have been prepared not quite at the end until things closed off. Now, I just wanted to look at, with precious metals, are the price drivers currently, which have been enormously positive, are they sustainable? Is this likely to continue? Or have we reached a point where gold has gone too far, too fast, and needs a decent correction? Now, we never know for sure, but let's have a look at the things that have been driving the gold price and whether they're likely to be sustainable. Now, concerns around US stagflation. I mean, I think that's real. I think that's a real possibility. But of course, economic data could change that. Global growth, will it slow because of trade policies? Well, we've just really got no idea because Trump is pretty clearly using these draconian tariffs as a means of driving other countries to the negotiating table, and then he'll negotiate backwards from there. But we're seeing some resistance from Canada, Mexico, China, Europe. So we don't really know what's going to happen with global growth. I think if Trump stays, if the status quo remains on what he announced a couple of days ago, then you can really see global growth taking a big hit because supply chains will take a big hit. The level of economic activity will take a big hit. So you can really see that that's real. But having driven them to the negotiating table, what will Trump then do? We don't know. There is another process, though, that I can't see any reason why this won't continue, and it's been running now for a number of years, and that's diversification away from the fact that the US controls global trade and the US dollar is the world's reserve, and they can impose sanctions, bank freezes, pretty much do whatever they like. And the rest of the world is not liking, and there's been a process of diversifying away. So therefore, if that continues, and I think that's a very good probability, then the US dollar is going to be under pressure to the downside, and that, of course, is good for gold. So that looks to be a sustainable driver to me. A weaker US dollar, of course, it's hard to anticipate. Geopolitical uncertainty, I think that's a given. I can't see that changing. There is just too much of an extraordinary difference between East and West politically for that not to continue, and that will be a supporting factor for gold. And then, of course, we've just got the natural dynamic. With gold hitting the prices that it's hitting, it brings supply out of the woodwork. People that want to raise some cash might want to sell some jewellery that they wouldn't have sold at $2,000 an ounce, but they'll sell it at $3,000 an ounce. There's that. There's increased levels of scrap coming back into the market. And just general profit taking. You know, gold at $3,000, it got there very quickly. Went from 2,500 to 3,000 very, very fast. So that just brings out some natural profit taking. So those natural dynamics are working the other way. They will tend to put a lid on the gold price. But will they be offset by these first four? And my probability assessment at the moment is that yes, they will. So I think the probability is that gold continues higher. Turning now to other commodities, copper was at 4, came right back down. Remember, it was only 2 weeks ago, I think. I had copper at $5.15. Now it's at $4.37. It's extraordinary, the hit that copper has taken. Nickel also has dropped the best part of $1. So absolutely belted base metals on fears about global growth. Crude oil also got smashed last week, down to 62. broke some key support levels. So let's look at copper. You can see we're at $5.23. Just, I think that's 2 weeks ago. And now look where we are. Took months to get up there. And basically, most of it was done in the most recent week. There's crude oil. Harder to see because I've put this on a 5-year chart because I wanted to pick up where the long-term lows are. But the view we've been looking at recently, this was the support level through here. These lows through here was the support at around 67. But we've smashed right through that. And now we're sort of down to another key support level provided from partway through 2021. So wrapping it all up, I know it's been a long video, but I hope you've got some great value out of it. Don't be a victim. It's so easy in this market to be a victim, to see your account value going down day after day, and you get despondent about it. I understand that. I've been doing this for nearly 40 years. I understand what the emotional reactions are like. I understand all the mistakes that investors make. But you don't have to be a victim. And what victims do is that they sell first and they think later. They don't think about the perspective that I've presented in this video. So I would really encourage those who don't want to make the same mistakes again to maybe watch this video more than once. So you don't have to be a victim of that. You can get a clear perspective that should calm the nerves. And the long-term history tells you that you'll be far better off. Go back to the start of this presentation and look at those numbers from JP Morgan. They should scare the pants off you if you try to sell your way out of and buy back into these market corrections. So learn from history and learn to use the perspectives from history. Develop simple clarity and conviction in what you're doing. Now, for most people, that is near on impossible to do without support. It's just too difficult. You've got too many diversions. It's just too hard to do. So get some support to do it. We're entering a tremendous opportunity period if you'll just allow it. This volatility is your friend. It's setting up amazing buys. If you're looking to buy a stock like Google, for instance, and that's not a recommendation, it's just an example. But if you want to own an asset, forget that it's a stock. If you want to own an asset like Google and you want to own it for the next 5 years, then we're not that far away from just a wonderful opportunity that we haven't seen in years and years. So this volatility is not your enemy. It's your friend. You just need to know how to work with it. Employ someone to call the play because you've just got to have been roughed up and bruised for as often as I have to be able to have the perspective that keeps your head straight. Now, portfolio analyst this week coming. No prizes for what I'm going to be covering. And you can do the portfolio analyst trial for $1. That's one way to discover if you like my methods, if you like my approach, if you like my perspectives. If you haven't done it before, try portfolio analyst for a couple of weeks for $1. We're going to be preparing for the lows again, ongoing. But whatever you do, if you're preparing for the lows, you have to do it now. And I also think you need to do it away from live markets because when the markets are live and you're having a peak, your emotions are getting engaged. You can't think clearly when the markets are live. So do it away from the markets, do it on a weekend, and definitely do it away from the media. Don't start preparing for the lows when you've just read the latest from the media, which is telling you how bad things are. It's almost impossible to keep your head straight in that sort of environment. So that's it for this presentation. There is more information on our website. There's my email address. Critical, pivotal time in history. You've now got an opportunity to change a formula you've been using, which has not been producing the results that you want. Because if it was, you're probably not watching this video. So you've got an opportunity to change what hasn't been working to something that history and quantitative analysis shows you works far better and is far better on your psychology. So I'll leave it at that. I'll be back with you next Sunday. Cheers.